What we said back in August was that we certainly would not even consider raising interest rates until we hit that 7% target. What we've now moved on is to, and we announced last week, was what we might call a second phase of guidance, which has to look beyond the lift-off date, if you like. And what we have said is we still believe that there is room for this economy to grow some way further before we have to think about putting up interest rates. There's still a reasonable amount of time there. And then even after we have to start to push up interest rates as the economy starts to normalise over the course of the next 2 to 3 years, what we plan to do is to push up interest rates only very gradually. And to give you some idea of what we mean by gradual, what we have also said is that once we get to the sort of interest rate you'd expect to be normal for this economy, once it's at full employment but with inflation still at the 2% target, that we think will be significantly lower than the sort of interest rates that people were used to prior to the crisis for quite some time.
And that's important not just for people who have mortgages, it's important for savers and businesses, because everyone wants stability. They want to know that, well, within the next 12 months, interest rates, they may go up 1% or they may go down 1%. They're not going to go up 4 or 5%, which was the case in the 1980s and 90s.
I think that's certainly the message that we're trying to send. And I think the secondary message behind that is to say we need to ensure that the economy is strong enough and sustainable enough to absorb those rate increases as and when they have to become necessary.